as always, we appreciate your feedback, and thanks for coming. Bob?
Good. Thanks, Gary. Welcome. Appreciate you having me up here to talk about this topic that's near and dear to my heart. I may have mentioned to some of you, I'm actually a native of Cleveland. I was born here, as my brothers were as well. So over at Fairview Park Hospital, long time ago. I was young at the time. But so it's good to be back. I'm a father of 4 kids, 2 of my own, 2 stepkids. So I have some perspective on this whole retirement planning thing. They're all in college at the moment, which is a bit of a problem. But other than that, everything is good. My background, just real quickly, I'm a CPA. I'm also a certified financial planner. And the CDFA means Certified Divorce Financial Analyst. So that comes into play at times as well. So why don't we get started? The agenda here, straight talk on distribution rates in retirement, planning your legacy, and then the sexy tax planning opportunities. I thought that would be a good marketing hook. Taxes and sexiness are kind of an oxymoron. And then I certainly want your questions. And at any point in this presentation, please ask questions. You can interrupt me at any time. But the first topic there on the distribution rates in retirement, it's a hot topic at the moment. You know, just it's been around for a long time, and I think there's no one right answer is really the crux of it. So just as kind of a setting, you know, on the retirement period, I mean, it's an odd experience to go through in your life. You go through your whole life saving, right, and earning, and then all of a sudden you're supposed to switch a switch to spending, and so it's a very unsettling time. And you know, when you had a paycheck coming in, you knew how to set your budget and how to meet your expenses. A lot more unknowns when you have the consuming side with no income coming in many cases. You know, another factor, a big factor, is your cost of living and how does that change. Met with a elderly client yesterday, close to 80 years old, still in very good health, no long-term care insurance. She's not going to get it at this stage in life, okay? Has not had any health experience, but tomorrow that could be a different story, right? And then, you know, any contingency planning. These are all aspects of it. I mean, if you try to make plans in life, obviously things change on a dime pretty quickly. So the answer to this, you know, how much can you safely withdraw? We're going to go through an example here in a minute, real life, you know, or example we can kind of talk through. But how much can you safely pull out? What have you read or seen in literature on this? Have you seen any topic or, you know, articles, things of that nature?
Depends on how long you're planning to live.
Yeah? Yeah, how long are you going to live? That's good news and bad news. We're living longer. The bad news, we're living longer, it costs a lot of money, right? But what are the factors that come into that? What have you heard in terms of percentage?
Nothing.
Nothing? Sky's the limit? What would you guess?
I know in endowment funds for nonprofits, that 4 to 4.5% is,
Yeah.
is a typical.
That's right, I gave you the answer up there. You
Yeah.
guys.
Yeah, okay, but then that's what I've always gone on.
Yeah.
It seems high though. I mean.
What's that, 4% or 4?
Yeah, I mean, if you need that to sort of go on and you're gonna have fluctuations in the market,
Right.
I don't know. And
It might be high. There's a lot of debate right now. The honest answer is no one really knows, and it's so individualized based on your situation. Do you have a pension? Do you not? Do you have other sources of income? I have one client who has a private pension with GE. He also has investment real estate that generates income plus Social Security. You know, big difference on that person from someone else that may not have those. But generally, the general rule of thumb is between 4.5%. How do we get there? How you get there is really through the historical rate of returns for stocks and bonds. Okay? Historically, stocks have averaged somewhere close to 10%. Bonds, the intermediate bond, has been about 5% historically. Have we received those kind of returns of late? No. All right? So much of this withdrawal rate, the real debate right now is 4.5%, 5%, 4%, whatever, adjusted for inflation. The difficulty, though, becomes the less, or if we do not receive returns at least somewhat consistent with historical averages, this number gets closer to zero. I've heard some discussions around 3%, 2%. Frankly, the closer we get to zero, we're all, that's a serious problem. We do need this return. So, the biggest unknown here, and this is why it's highlighted, is just this whole notion of whether or not we're going to receive the long-term averages. But remember, these are averages. Not every year is going to be a banner year. Last year was somewhat flat, but if you recall, in 2013, the stock market returned close to over 30%, right? The S&P. So you got to take some of this with a grain of salt, but certainly since 2000, the market has been a very inconsistent performance, correct? Right? And then again, the stability of your different income sources. So if you have Social Security, pensions, things of that nature, that can also change the profile a little bit of what you're pulling out. Does anyone appreciate what I'm saying about 4%? What does that mean? 4% of what?
See, everything you're talking about now is irrelevant because everything I plan for retirement doesn't exist. You can't invest. You have to invest in the market, which is a crapshoot.
Right.
And there you can't buy CDs and get a guaranteed income. So what do you do?
Right.
I mean, bottom line, that's it. When you're retired, everything changes.
Right.
The main thing I want to do is maintain my capital.
Yeah, they maintain the capital, live off the income.
Well, I just want to at this point, I just want to maintain capital.
Capital.
Which is hard.
It absolutely is hard. What's the biggest challenge to that?
Just getting out of the market.
Right. Right. Well, right. I think the antidote there is to come up. We'll talk a little bit more about this. Is it's tied into your investment plan, right? Your investment plan should contemplate this, and I think let's talk a little bit about where does this 4.5% come from. Certainly, dividends and interest from investments comprise part of the income, but we also have hopefully capital appreciation of our portfolio, right? And when you go to spend money, does it matter if it came from a dividend or a capital gain, or it all kind of spends the same, does it not? So I think the expectation for income, there's certain restraints. The market will only give you what the market's going to give you. And right now, dividends are probably not much more than 2% on average for the general stock market, right? Certainly there's some that pay more, some that pay less, but on average it's zeroing in around 2%. Bonds, we're at the lowest rate of interest, that we've so back to your point, it's a little bit concerning. Where does the income come from? And certainly in a year the way this year has started, where does the growth come from, right? So these are concerns, but the expectation is that we should see some growth over time. But if we don't, that's going to have ramifications to your retirement planning. There's lots of variables that go into this. The only thing that we can't plan for is this. We can control spending, right? Things of that nature. We can mitigate for various risks that may come up, like long-term care, things of that nature. But what we can't control for is returns. But the best thing we can do is hopefully come up with a sound investment plan that fits your age, risk profile, time horizon. Those are the things that really why we do what we do. Any other questions, comments on this? Okay. I think what's been distributed here is this example. I thought instead of just talking about it in theory, I also want to give you kind of a quick and dirty example. This is a case study. The person has $1 million of assets. Age 65, spending a cost of living on an after-tax basis of around $65,000 a year. Okay? And as you'll see, this grows by about 3% a year. Okay? Receives Social Security income of about $22,000. We will not start taking a minimum required distribution until about age 70. Okay? This column right here, to or from savings, is essentially, it's a net. Don't try to do the math to get to a net number here. It includes taxation of capital gains, things of that nature. But essentially, this is the net pull from the retirement. We were just talking about 4.5%. That is what that number represents. As you can see here, you know, it averages out somewhere in the neighborhood of, you know, between some as low as 2.5%. She's got about $1 million of retirement assets, $250,000 in a brokerage or after-tax account, $750,000 in an IRA. Those are the assumed growth rates on the returns. Okay. So if you see someone that's a female, this is an example using a female's life expectancy. They have a life expectancy of about 18 years. Okay. What's the life expectancy of a man at 65? Anybody want to guess? It's closer to 15 years. If you're married and at 65, magically it increases to 22 years. So there's something to be said for marriage. So if you look at this, and it's growing by 3% a year, you can see that the money doesn't run out until about, close to age 90. What's interesting, at 3% inflation, your cost of living will double in about 24 years. Okay. The interesting part about where we are at this point in time, while we're not getting maybe, say, some of the income generation from our savings, such as CDs, as you mentioned, we're also not experiencing 3% inflation. Okay. But historically, inflation has been a big driver of retirement planning. So this is an example. You want to be conservative when you do this type of analysis. Okay? Is everyone with me here? And this is kind of the base case. Any questions on this? This is a simplistic way of looking at it. You've got standard or compounded rates of return going on here. Obviously, that doesn't exist. But on average, it's going to average around 5% or 7% on a pre-tax basis. I guess before I go on, everyone understand how the minimum required distribution works? When you reach 70, the IRS says, okay, you've had a free run for 70 years. It's time for us to start getting some of our money back. And so when that happens, they use these are government-issued divisors. They're not percentages, they're divisors. And at age 70, the divisor is 27.4. So when you turn 70 and a half is when it has to start happening. You take the end of your balance of the prior year in your qualified accounts and divide by 27.4. That's how you get to the minimum required distribution. Okay, so this is our base case. Our person here doesn't run out of money until about age 90. Same case here, but now we've got $750,000 in assets. Okay, same set of facts, still spending $65,000. What I wanted to show you in this example of how much it shortens the assets, they run out at age 82. So close to about 8-9 year difference. Okay. Same exact fact. Still spending 65, getting 22,000 of income, same investment returns.
What did you change on this?
All I changed here is I took out $250,000 of assets. Same scenario, just 250,000 fewer in assets. Okay? But it has a real big difference in terms of when do the assets theoretically run out. This last example is, again, lower assets, $750,000. But the difference this time, though, is this person takes the initiative and says, look, what can I do? I'm concerned about running out of money. So they come in, talk to their friendly financial planner, and they say, well, how about if we stop betting on the ponies, okay, or going to the casino, and maybe cutting out $5,000 of spending. So we would go from $65,000 after tax just to $60,000. And I think, that's a reasonable reduction in our budget if you were faced with that type of situation. The other addition here was maybe at 65, where you are living longer, there might be an opportunity to do something that generates a little bit of income. And that's what I want to show is just a little modest amount of income, $20,000 roughly, growing at 1% a year. Again, you're going to get some Social Security income. You're going to have the same growth in your assets. But it takes a situation where somebody runs out of money at 82 and then stretches it out towards the end of the 80s, 89, adds about 7 to 8 more years. Okay, so same set of facts, just a little bit of tweaking, just a slightly different set of facts, I should say, reducing spending slightly, adding a little bit of income. Thoughts? Make sense? The one thing I would tell you about this type of analysis, this is a traditional cash flow projection. There's lots of tools out there. Be happy to share with you the tools that we have in this area, okay? The difficulty at times, though, I think there's a degree of precision that doesn't really exist here, okay? When doing this sort of analysis, I think it's very helpful, but reality says we're good, we're not so good that we know what's going to happen 10 years out, okay? But at least this will tell you whether or not this kind of stress tests a little bit your plan. Through this process, what you can do is say, well, what if my spending is higher? What if in 1 year we decide to take the vacation of a lifetime, right? Or every other year or perhaps we want to do gifting to kids, right? Or charity. So what you can do in this exercise is change things around. What if rates of return are lower? What if they're higher, right? So you can kind of play with it. I think it's very helpful. I think sometimes, though, don't get too wedded to the absolute numbers. But what this does tell you is generally if you're directionally in the right spot. If it says you're running out of money 5, 10 years before your life expectancy, then you've got some real issues to face. All right? Comments? You with me?
$750,000. It's at the top there.
Uh-huh.
In the box. Under the assumptions here, there's at year 18, there's still $750,000 working at that year.
What you're saying here?
Yeah.
There's about 456,000. Yeah. But remember the time value of money, right? This $456,000 10 years from now, or I guess this is closer to almost 18 years from now, is a lot less than $456,000 is today. Make sense? Okay.
I guess I have a
60,000 is covered.
Yes.
comment, though, with, like you mentioned, long-term care insurance.
Right.
With my mother, I found that it doesn't really take care of all that.
Correct.
much as it, so it's a, both policies only will take care of you for 2 years of long-term care. And
Right.
exclusion period before you can get into it, and it's only a percentage of what the
Right.
long-term care actually costs.
Oh, exactly.
So that's, it's far as, I mean, maybe there are better policies out there,
Yeah.
but,
You're right. There are some ways to craft that. That is an area we could have a multi-week session on long-term care. But you're absolutely right. And for most people, long-term care fits into the plan somehow, right? There's got to, either that or it's a roll of the dice. But there's different ways to tackle that. You can structure policies with more coverage, longer terms. In a married situation, you can have a joint benefit, because rarely do couples go into the nursing home hand in hand. Usually one person might need it in advance of the other, right? But you don't know which one is going to need it first. You got the exclusion period, as you mentioned. There's also, if there's other sources of income, such as a pension, things of that nature, those will continue, right? So, but what you're talking about is a very tricky dilemma. It's one of the biggest challenges your generation are going to face, this country is going to face. So many people are showing up at 65, approaching retirement years with not enough saved, okay? Let alone to take care of the long-term care need. There's going to be a lot more shift into stay at home, stay in place, monitoring remotely with in-home nursing care. Far cheaper to treat someone at home than it will be to build facilities that eventually, when the baby boom generation works through the system, is there's going to be an excess capacity of nursing facilities. I serve on a long-term care facility board in the Cincinnati area. It's a very interesting dynamic, that's for sure. All right, so I think you get the picture here. This is kind of a pretty straightforward stuff. So I think where this starts is define the goals that you have for yourself. I know this is a pretty simple observation, but I think it's also very important. Is you have to understand, and the goals can change. When you think about retirement, how your goals and needs at age 65, say, could be a lot different than they're going to be at 75, right? Maybe by 75, you've done all the traveling you want to do. Maybe health is more on the forefront, things of that nature. Because without clearly defined goals, it's difficult to kind of prioritize your planning needs. And it ties directly into your investment strategy as well. What's your time horizon? How much income do you need? Okay. The second bullet point, develop some cash flow projections. If you haven't done that, we can help you do those sorts of things. Understand what you're spending per year. I know that's a simple concept, but that's a very, very important. There's really no portfolio can outperform unsustainable spending. Don't expect the market to bail you out. Isn't that a happy thought? You came up here to be uplifted. And then make sure your other areas of your financial plan are oriented around the plan, right? All these disparate pieces, whether it's long-term care, other aspects of your financial life, need to be centered around this whole goal, okay? And then you don't have to update it quarterly. You don't have to update it, just probably once a month. You need to go back and revisit, check in the assumptions that you made. How do they change? This is a living process. It changes as your life changes. Kids come on board, your grandkids, illness, there's death, there's divorce. All those sorts of things can have an impact on your planning process. Before I move on, any other questions on the retirement planning and so I mean, just to kind of recap on that, it's just how much is enough? It really depends. I've seen people make it last on I've met with people making $1 million a year having a hard time making ends meet. Amazingly, okay? But, so it's all relative. There's really no single answer. Any questions before I move on?
I remember somebody saying that The definition of rich is about $10,000 more of disposable income than what you have right now, right?
Yeah, exactly. True story. I had a client come in and ask to see if we could figure out a way to help him generate $10,000 more of income. We asked him for all his statements, found about $1 million of assets, didn't realize he had. True story. Anyway, legacy estate planning. Let's talk about this for a second. Tax planning is largely irrelevant these days, unless you're very fortunate and exceed $5.4 million or so individually, or $10.8 million as a couple. So if you've been keeping up with the news in this area, there's been dramatic changes since the early 2000s, okay? There was one year, if you recall, I think it was 2007 or so, where there was zero estate tax, federal estate tax. You know who died that year? George Steinbrenner. And can you imagine all the tax planning he had done in his lifetime? In the year that he died, it was literally zero estate tax plan, zero federal estate tax. So here in Ohio, though, we've also done away with the state estate tax, okay? So really, tax planning for most folks is largely irrelevant, as I said, okay? So really, the key points of emphasis here is just organization and simplification, okay? One of the best gifts you can give to your children and your heirs is to get your own house in order. Nothing's worse than in a period of stress to have to sort through somebody's estate, okay? But the things you need to focus on are things like healthcare decisions, power of attorney, okay? There's been changes in the privacy rules, HIPAA, things of that nature, and very important to keep current on that stuff. Very simple to do. And most assets can be transferred with just a simple beneficiary form, okay? So that's really the lion's share of it. Yes, there's use of trust. I can talk a little bit about that if you'd like. Blended family situations, talk about complicated. That gets very complicated. It's very likely to happen in most families. In some, whether it's you directly or whether it's one of your children that may go through a divorce or lose a spouse, something like that. This last point, there's often a need to coordinate with the next generation. I once had a client come to me and have a desire to make a gift to their grandchild for 529, college planning. And she asked me, she goes, is 10,000 you think a good number? I said, sounds like a good number, but what have they done in terms of college savings? How much have they set aside? Have you had that question, right? And so one of the things we don't do well as a general rule is talk about money. When we get together for family occasions, we don't sit around and talk about, hey, Mom and I have been updating our estate plan. It's a real doozy. Let's talk about it, or tell me how. We talk a little bit about it, but these are things that we do need to start having a little bit more conversations. You can have family meetings. You can communicate your intentions in a letter, that type of thing. So I highly recommend that once you get your estate plan figured out, that you do share a copy or communicate with the next generation, because typically they're also serving in some of these roles as healthcare power or power of attorney, things of that nature. Any questions on any of these topics? Okay. So really the planning thoughts here is first of all, just pull out your estate plan. First question I'll ask people is, when did you do this? And usually it's when children were born. That's usually the impetus why people get estate plans put together in the first place. And if it's been over 5 years, I would say definitely have it looked at, okay, for a quick update. And if it's over 10 years old, absolutely. Most estate plans have been put together with an A-B trust structure, and those really reflected the old $1 million limit on estate taxes. Used to be if your estate hit $1 million over that, it started to be taxed at close to 50%. So there has been a lot of use of AB trusts, credit shelter trusts, ILETs, things of that nature that were designed to avoid taxes. Well, taxes really aren't the issue anymore. Also, you know, these people you put in roles for trustees, power of attorneys, you name it, are they still your good choices or not? They may be, they may not be. Just update that. Definitely do this part of it. This is if you do nothing else from this gathering, go back and check every asset that you have in terms of a bank account, insurance, brokerage, IRA. Look at the beneficiary designation. If something were to happen, where would this money go today? You can create the best estate plan, but if you don't align everything else to that, it was a waste of time. Because if something happens, you go to the custodian, they're going to send it to the beneficiary. And they're not going to say, oh, you know, oh yeah, you meant to put it over here in a trust, but you know, if you don't designate the trust as the beneficiary, it doesn't happen. Okay? As I said here, communicate your intentions to your family members, but above all, just keep it simple. There just isn't a need to overcomplicate estate planning these days. Everyone current on their estate plan? It's not the most enjoyable conversation in the world. But once it's in place, I think you can, you know, especially under today's rules, I think it only gets, there's no real risk of going backwards. So unless you're going to be bumping up against the $5+ million individual exclusion, chances are you put something together, it should have pretty long lasting, you know, it should last a while, right? Everyone knows what goes into an estate plan. You got a will, healthcare powers. Healthcare powers will determine what goes on with your health care. A living will is end of life decisions. Who makes those decisions? What do you want from that standpoint? Powers of attorney give legal authority to do transactions on your behalf. Okay? Those are very important skills. Let's go to taxes. There's a bazillion taxes to consider. Putting this slide together, I was a little surprised at all the different topics that come up, but it's one of the questions that's always ever present in financial planning is how does tax strategy get incorporated into your financial plan? Any ideas? No? Yeah, keep it simple. What I would say, the tax code's very complicated. Pages and pages, depending on what kind of activity you're involved with to generate your income, whether you own a business or just you're an employee, you're going to get swept up in a variety of different tax issues, and it's kind of confusing. The general rule is people don't like paying more taxes than they need to. But I think the mistake I see people making more often than any is just not having a clear understanding of what their true tax situation is. Okay? So what can happen, the risk of that is there can be missed opportunities. Okay? There's a perception they're paying more tax than they really are. And then, you know, they'll lead to making decisions kind of on a false set of you know, assumptions. Okay. So where I would start with this is understanding your current tax profile. Okay. So we're in the middle of tax season. We're going to be filing our taxes here shortly. And what I mean by this is understand both your marginal rate and your effective rate. Does everyone understand what I mean by marginal versus effective? What's the marginal rate? Everyone generally knows what that is. Yeah, it's the rate of tax that you pay on the last dollar earned, right? And so what will happen is as your tax bill, we have a progressive tax system in the sense that the first dollar being taxed is very low, And then the more you make, obviously, the more tax you pay. Just to put it in perspective, for married individuals filing joint, the tax rate is 10% on the first $18,550, okay? Then it jumps to 15% from $18,550 to $75,000. And then after $75,000, that incremental amount up to $151,000 is taxed at 25%. Then it jumps to 28%, 33%, 35%, and then it finally tops out at 39.6% when you make $466,000 or more of taxable income, okay? So that's your marginal, those are your marginal brackets, right? But the reality is when you go to file your taxes, you're paying a blended rate of those various brackets, right? So the mistake a lot of times people make is marginal rate's very important. It's important in investment decisions, employment decisions, things of that nature. But I think you also have to be aware of what your effective rate is. And your effective rate is calculated by taking the tax that you pay for the year, divide that by your adjusted gross income or your gross income if you'd like. Okay? That kind of tells you effectively what was your, hey, I made this much money and this much money went out the door. You're going to see your effective rate is much lower because you're going to have deductions. I had a situation where I had a doctor client who swore up and down he was getting killed in taxes. And to a degree he was, but when I figured out his effective rate, it turned out to be 18%. He was making over $300,000, $350,000, but his effective rate of tax that he was paying was about 18% on a federal basis. So I sent him an email and said, which one is it? Is it A, 25%? You know, I threw some red meat at him, and sure enough, he grabbed the red meat. But it changes your perception. Why? Because, for example, how does it affect your investment strategy? Depending on your tax rate, if you invested in a municipal bond, for example, for the tax-free benefit, what is your pickup from tax savings? And is it sufficient, right, to warrant investing in a municipal bond versus maybe a higher yielding corporate bond where there's tax, right? So the only way you know that, you know, municipal bonds are worth more generally for people that make more income, right? The higher your tax rate is, the bigger lift you get from the tax-free nature of that investment. But you can also see where folks will chase because they just hate paying taxes for one reason or another, and that's fine. But they may be making some decisions that aren't necessarily in their best interest, right? So the key too on tax planning is look at your time horizon, especially this is a retirement planning discussion, right? Either you have retired or approaching retirement. Well, a lot changes. Your income changes, doesn't it? You might go from making a good income one year, you hit retirement, that income's no longer there, and now you've got your investment income and maybe some Social Security, depending on how old you are. Well, the reduction in your income could create a tax planning opportunity. One of those examples would be a Roth conversion. We'll talk a little bit more about that in a second. Okay. But I think one of the things, the big aha moments I find in most retirement planning is just the taking advantage of the bumps in the inflows and outflows and kind of knowing, looking ahead and saying, look, I know this year my income drops way down. The following year it's going to go back up again, you know. Because the one thing too to tie into this is all the, like the IRA distributions. As those start pulling out, some people are in an enviable position where their income's actually higher in retirement than it was during their working years. Right? The last point I would make here on the where to start page is don't let tax planning tie you into a knot. Okay? I've seen too many instances where it's overly complicated. You want to have a simple tax strategy that reduces taxes as best as possible, but without it being the sole purpose. I'll give you a real life example. I had a client with a position in Citigroup, okay, Citibank, about 80 something thousand dollars, okay? Cost basis of around $4,000, okay? Financial crisis comes through. Well, I should say the lead up to that, it was his largest position by far in his portfolio. And I kept telling him, you've got to reduce this or we've got to protect this. I don't want to spend more than $4,000 in capital gains taxes. Financial crisis rolls through. This stock is now worth probably less than $5,000. From 80 something thousand to less than 5,000. He lost far more in value than he would have paid in capital gains. I'm not here advertising let's all pay capital gains, but just as a reminder of this tail wagging the dog, don't let a 15% taxable gain get in the way of prudent investment management. So, yeah, that was a tough one to watch. And then he still had a gain. The reality, the sad part is after all that loss in value, he still had a gain. So here are some tax planning ideas. There's others out there. If you want to talk about one that I'm not touching on, if you came with an idea in mind, you want my opinion on it, be happy to share. But one of the more simple things you can do is portfolio structure. Be mindful, and this is what we do here at Carnegie, is that we are looking at tax efficiency in building your portfolio. What I mean by that, interest from bonds or CDs are taxable at ordinary income tax rates, okay? So if you look at the construction of your portfolio, more often than not, you're going to find bonds and interest-bearing investments housed inside of IRAs or 401k type of accounts, right? So investments subject to capital gains, like stocks, you want to take advantage of those because those, maximum, assuming that you're below the income thresholds, would be only at 15%. The one thing I did not mention was with the Affordable Care Act surcharges, there's one of the changes was to the capital gains rate. It kicks in at a much higher rate. I think it's over $450,000, somewhere in that range, where income, capital gains above that rate are charged at 20%. So the investment tools you use are also key to the whole tax management strategy. Again, here at Carnegie, we oftentimes are using individual stocks and individual bonds, as opposed to, we also use mutual funds and ETFs. But how individual securities are taxed compared to mutual funds and ETFs, there's some subtle differences there, but meaningful. A mutual fund can be very helpful in building out a portfolio, but inside a mutual fund, they're doing trading. That trading activity carries forward to the owner of the mutual fund in the form of capital gains distributions. So you may not sell a share all year and still receive the capital gains distribution from the mutual fund. Whereas with individual stocks and bonds, it's a little bit more precise instrument. You can tax sell an investment, right? If there's a need to take a loss or to offset a gain, something like that. You can do that with a little bit more precision. So Roth conversions, I mentioned this earlier. Anybody interested in doing a Roth conversion? Kinda, you're thinking about it? Okay. Roth conversions can be a great thing, and depending on your situation, I'll give you a couple examples. One, I have a retired Rear Admiral of the Navy as a client, has a government pension, as you might suspect. Interestingly enough, he does cruises for fun all the time. You would think after a career in the Navy, you would be done with cruising. But anyway, he'd like to leave his grandchildren this money, okay, that he's built up inside these IRAs. So what he is looking at is converting some of his IRAs to Roths, and then at his death, this money then would transfer to the grandchildren, who are all below the age of 20 at this point. And when they receive this money, they get to stretch it out over their lifetime, tax-free. Okay? One of the biggest things that you see with the Roth conversion, The factors that go into it is what's it going to cost you to do the conversion, meaning when you take an IRA or qualified money and convert it to a Roth, you have to pay tax in the year that you convert it, okay? Unless you fall within the income ability to make a direct Roth contribution. But let's assume in this case it's a Roth conversion. If you do a Roth conversion, you're going to pay tax on that. So this is what I was saying about ebbs and flows. Sometimes there's an opportunity when income comes way down, all of a sudden someone finds themselves back in the 15% tax bracket, for example, okay? In that year, that might be a good year to do some, you don't have to do it all in one year, you can do it over multiple years. When you think about it, money being pulled together inside of an IRA, okay, eventually, through that minimum required distribution starting at 70.5, it is going to have to start coming out. And as you get older, that denominator gets smaller. A larger percentage has to keep coming out. Yes, sir?
You have to take minimum distribution out of Roth.
Excuse me?
You have to take minimum distribution.
No, you do not have to take a minimum distribution out of a Roth. That's one of the key advantages of it. But the reality is, in converting to a Roth, there's a toll to be paid, right? So we got money in a qualified account that we're now converting into a tax-free account, right? So one of the drawbacks to a degree to a Roth conversion later in life is that you're pulling the tax forward, and you got to ask yourself, is there enough time to recoup the tax paid, or are you better off leaving it deferred, right? That's really kind of the crux of it. So what it comes down to is planning through, looking ahead in the years to come to say, look, I'm going to have a lower income year this year. If I put in $50,000 for the next few years into my Roth, I can pull out about $150,000, $200,000 of IRA money and only pay 15%. Or you can leave it all in the IRA, and maybe it gets bigger, you know, and then you end up in that situation where, you know, potentially you could be paying a higher, because when money comes out of an IRA, it's taxed as ordinary income, right? You're going to get taxed one way or the other. So the question just becomes, it's really a math problem to figure out, does it make sense to convert some of the Roth? And it really depends on each of your individual tax profile, okay? Some instances, there's just enough income coming each year. I was just at it with a client. We were talking about this very topic, but between pensions and Social Security and things of that nature, it just didn't make sense because their income was high enough where, you know, the cost of it, they had more benefit from tax deferral. Okay? So those are kind of some of the factors that go into. You also have the ability, if you want to explore this and do this sort of strategy, there's this deconversion process. You can give it a go, and if for some reason the market tanks or it just doesn't make sense to do this, you can kind of unwind it and reconvert it back to your IRA as if it didn't happen. Okay, so they do give you an out on that. But these are very powerful tools, especially in the context of legacy planning, in your own planning. One of the benefits, I think, in a financial plan is when there's tax diversity, when you have different types of buckets of money that are taxed differently. It's okay to have some deferred money, qualified money, but it's also great to have ready cash. This falls under that category of ready cash, and certainly there's rules related to Roths. Any other questions on Roths before I move on? All right, still want to do them? Yeah, they're not bad. They're not a bad planning advice. Rollover tax strategies on the 401k. If you are in a situation where your company gave you stock as part of your stock ownership, there are ways to potentially roll over some of these holdings in a way that are kind of unique, where you can roll over the basis and leave the unrealized appreciation on the outside. They're kind of very different, but there's some strategies involved with that. I mentioned donor advised funds here. Anyone know what a donor advised fund is? It's a charitable, it's a great vehicle. What's that?
Fidelity has that.
Yeah, all the major custodians have an arm.
So it's like your own mini foundation.
Yeah, it's like, exactly. It's like your own mini charitable foundation. And what happens is you receive the credit for the charitable deduction in the year that you make the donation to this, make the transfer. It's an irrevocable transfer, but you get the tax deduction at that point in time. And then you can fund it in future years and then make distributions. At the time you make distributions from the charitable foundation, you don't get another tax deduction. You take it at the time you deposit the money. But these are, they're required to be set up. There are some expenses related to that, administrative costs. But it's a great way if you find yourself with a slug of high appreciated stock. And again, in the context of overall tax planning, it might be a way to say, look, I'd like to take some of this. That's one of the better ways too, is just if you're looking to make donations from a charitable standpoint, you're much better off sending, giving them shares of stock, of appreciated stock, than cash. If you pay with cash, you're paying with after-tax dollars, right? To donate $100, you might have to generate 120, right, if you pay in cash. But obviously, you do get the charitable deduction as well. Gifting, $14,000 a year, annual exclusion. The gift tax, oftentimes get a question on the gift tax. The gift tax really doesn't apply. You saw the earlier slide of the individual exemption being about $5.4 million. You can give gifts up to that level before gift tax kicks in. Okay, so if you were to make a gift to someone in excess of $14,000 in a given year, all that's required of you is to do an administrative filing of a gift tax form that says, IRS, in 2016, I gave $20,000 to my child. That's $6,000 more than the $14,000 you let me do without any strings attached. So when I die and I file my federal estate tax for the last time, we're going to start with the total exemption and then take $6,000 off because I gave that away in 2016. Okay? So you often hear, oh, am I going to be subject to gift tax? No, you will not, again, unless you're in a really high value in your estate. Okay? The other thing I would mention is, to avoid some of that, I should point out, this $14,000, if you and a spouse wants to give money to a child, you can give $28,000. You can each give $14,000, right? And then also, the gift tax does not apply if you want to help, for example, with a grandchild's schooling costs, okay? If you pay the school directly, then it doesn't count towards this $14,000 number, okay? And then you can also do the 529 funding. What you can do there is there's a limit, but you can do 5 years worth of gifting in 1 year. If you want to kind of supercharge an account, the rules allow you to do 5 years worth, 5 times 14, so you can do about 70,000 or so into a 529 plan. The only difference is over the next 5 years, you can't make another gift to that person over that next 5 years.
529 is for college, right?
Correct.
Graduate school.
If you have a grandchild and the parent set up a 529,
Right.
and I throw some money in there, is
Right.
it tax deductible for me?
Only minimally at the state of Ohio. It is not on a federal basis.
Okay, so I can only, my son can take, if he puts money in there.
He can take I think the grand total of the deduction in the state of Ohio is something like $100 off your state taxes.
For me,
For you.
but for him, he gets the whole thing.
Well, it's not for him. It'd be for the child. It's your account.
No, if he sets up an account.
Oh, he sets up the account.
And I put money in it too. You're
Right.
allowed to do that in Ohio.
Correct.
I don't get a tax deduction.
I believe you do, but I could be wrong.
The full, do I get a federal, or do I just get a state income tax?
It'd just be the state. There's no federal.
It's a state, and it's only on the first $2,500.
Right.
Right.
Just,
I think that equates to
And
about a
then,
$100 deduction, something like that.
44%.
So So it's very minimal. But the one thing I'd say on 529s too, we're fortunate we live in Ohio where it's got an excellent program. It's one of the better ones in the country in terms of low cost, the options, things of that nature. You can set up a 529 virtually anywhere. So oftentimes people will go to the custodian. For example, Schwab, I know their 529 is domiciled in Kansas, of all places. Doesn't make it good or bad. Your child or grandchild can go anywhere they want to school in the country as long as it's a qualified educational institution. But the difference is if you set it up at Schwab and make a contribution, you're not going to be eligible for the tax deduction. Okay, so you have to be in the Ohio plan, which is collegeadvantage.com. But they're very good vehicles. You know, the risk on 529 planning, what I would suggest is it's a very great vehicle because it allows tax-free growth, and then when you pull it out, it's tax-free for qualified secondary educational expenses and the college level. The thing is, though, make sure you're coordinating it with the parents, okay? And the other aspect of it is, you know, there's a game, and we can go on, about college funding, right? If child shows up, it's a kind of a perverse system. If child shows up to college with a big pile of money, well, guess what? They're not going to be eligible for a whole lot of financial aid. In most instances, people with any means will find getting need-based grants very difficult. There's more likelihood of getting a merit-based scholarship just based on the child's efforts. But it's kind of a perverse system. The more money you have available, the less they're willing to help. Okay.
I was just going to ask if you knew the parents' confidential statement, if they require that you turn in a statement from a
Yes, yes.
They probably do. Yeah, right, and you're right. That the only thing that I would say is that those financial aid offices are all negotiable.
Right. It's a little bit like the healthcare system. There's the gross amount that you're charged, but the actual net amount that ends up getting paid is very different.
Well, and I mean, you can sit down with them and make a deal sometimes too.
Or not. Depends on the exclusivity of the school.
Yeah.
Oh, you don't want this spot? Well, we got 1,000 kids ready to take it.
Well, but
Yeah.
my experience was we went in with half certificate scholarship. And there was the balance, and we made a deal to pay
Yep.
her tuition for the next 2 years at that year's rate.
Right.
There was
Oh, yeah.
and they accepted it, and because it was going up 8% a year.
Oh, right. Yeah, you're absolutely right. There is an opportunity to negotiate some of this in many cases. In schools, it's effectively, they're competing for students. That chair goes empty in their world. There's no income of any kind coming in. So, but I think with it though, you just have to just be careful. There's such an eagerness when this baby comes along to go ahead and make sure the road is paved and smooth, that the money will be there. You could also, frankly, as a grandparent, for example, pay directly, or be they don't ask for the grandparents' information when the child is applying for financial aid, right?
Anybody can set up a 529
Yes.
for somebody else. It
Yeah.
doesn't have to be the one that the parents set
Right.
up that then gets reported.
Exactly. And the other aspect of the 529 is that you might set it up for one child. They go on to become wonderful in athletics or music or something and gain a scholarship. So now the need is far less. So then next child, the beautifully average student, will maybe have a greater need because they're not going to be eligible for either a scholarship academically or otherwise. So then you can shift the beneficiary of these accounts pretty easily. Make sense? Any other topic? I mean, that's just a real cursory review of some of the tax. Those are some of the highlights. There's certainly more specific topics we could get into on the tax side, numerous. But I think the key part of all this is that you really have to this is really kind of the takeaway, is that too often the planning occurs in a silo. You know, you may talk to your estate planning attorney or perhaps do some college planning or insurance planning, and it's not being integrated. That's probably the biggest weakness I see in most retirement plans, is that you've kind of gone along, you've gotten different advice from different professionals, but the key is all this stuff has to be synced up and integrated around a common goal, time horizon, and that's where solid financial planning can really pay dividends for you, right? I can't do anything if somebody goes off and buys insurance without consulting me first. Not that, you know, why did you do that? We didn't need to do that for this reason or that reason, you know, that type of thing. So it's just kind of important to make sure all the pieces of the puzzle are fitting together around and it starts and ends with you. I know it sounds simple, but it's harder than it sounds to kind of pull off at times. Okay? Any other topics you want to cover? This is the question and answer section. Again, not sure, I really wanted to tailor it to what you wanted to talk about. So if I did not touch on something that you wanted to cover, please let me know. Anything? All right. Well, good. Well, thank you very much for coming. And I've left my cards here. If you need to follow up with me on a personal, with a personal question that you couldn't, you know, talk about in the midst of a group, be happy to answer a question for you. All right? Well, thank you.